Welcome to the Trading Desk, where money talks and conventional wisdom walks. My name is Dave Floyd with Aspen Trading Group, and I'm joined by my friend and colleague, Matt Davio of Red Rock Partners, and Jesse Felder of Felder & Company. Before we get into this week's show, let's do a little recap of what the markets did in January.
Since we last got together on the trading desk, a lot has happened in the market. The S&P 500 has now fallen about 22% from its all-time highs there at about 1575. Our next chart that we're going to talk about is a more positive chart, and that's the chart of gold. Who says gold is not a good investment? Gold has gone in the last year alone from $600 an ounce to nearly $950. So a solid over 50% move in less than 7 months in gold. The next chart we'll take a look at is somewhat correlated with the reason why gold is up so high, and that's the U.S. dollar. Is the U.S. dollar finally reaching a bottom after years of going down? In our viewpoint, it could be bouncing here soon. If we're able to break out over this $77 price level, we could see higher prices for the dollar. And the final chart is also correlated with the dollar, and that is the 10-year interest rate. Again, we've been dumping on the 10-year rate with all the Fed cuts. The 10-year is just pushed down to $3 or 3.2%, and looks to be also that there's some correlation between the dollar and the interest rates. Interest rates, if there is inflation, are going to have to go higher. Gold shows us there is inflation. Wheat hit an all-time high today. Oats hit an all-time high. Corn hit an all-time high. The markets are clearly showing inflation in the commodities. Oil hit $100, has pulled back to 84, and with this in mind, we would suspect that the interest rates would have to go up over the course of the next year.
As you can see from the charts, January was a rather interesting month, to say the least, and probably for most investors, probably rather a little bit scary. What we're going to do on this episode is we're going to talk about our 2008 investment outlook. We're going to talk about how you can construct your investment portfolio to be in line with the market. We're also going to talk a little bit about the local economy, local real estate, and we're also going to talk about our fantasy finance section, where we give you our picks for the next month or two. Matt, 2008, rough start.
Yeah,
what do you think?
well, I think January we finally took some pain that the market's been wanting to do, I think, really for the past year and a half. We've had...
First 10% correction we've had in I don't know how many years.
Yeah, it's been really 5 years again, going back.
Well, the sell-off at one point was the strongest we've seen since right after 9/11 when the markets reopened, and then prior to that was the 1987 crash. So there was some severe selling.
You had a lot of things. You had the French rogue trader, being put to blame, and there's who knows. We won't know what really happened behind the scenes there.
Actually, he was long SPOOs, and they had
kept
to go.
On in.
SPOOs meaning S&P 500 futures.
He had the S&P futures, and he kept putting them into the Nick Leeson 999 account, just like the Barron's deal, and until it finally blows up. And I don't understand that. I don't understand how a 31-year-old kid can even get into that. But the bottom line is the market's down 9-10% as we sit here early February. We were down 12, 13. We're down over 20% from the highs.
A lot of people are talking about a bear market.
Well 20% is typically the bear market zone.
Right? I think we are in a bear market. I had when the markets were going crazy a couple of weeks ago, I had the Ben Bulletin call me and ask me a bunch of questions, and my bottom line answer was, I don't know why this is a surprise to so many people.
Right.
So many deteriorating fundamentals. There was a way to position yourself
building, and we'll talk about that later today. And
right.
I think the big piece in a diversified portfolio is not only diversification of asset classes, but also
strategies.
Not being just long only. Possibly, cash is a way to be positioned for the future, as is being short the markets and different markets, as is being long.
I think it's what people have been led to believe over decades, that cash is not an investment,
right.
Shorting is not an investment.
Absolutely.
But we're going to get into more of that. When we come back from the commercial break, we're going to talk a little bit about what you can do for your investment portfolio to navigate these markets. You're watching The Trading Desk, and we'll be right back.